Okay. So the rules of the charitable remainder trust, when you've got this type of setup desired, in order to take the uncertainty out of what are these things really going to be worth, because the value of these determines the value of this. It's simple subtraction. 1 million less the actuarial value of these retained distributions for a period of 20 years in our example equals this. That's the leftovers. So the charitable remainder trust rules say, hey, you can do this. You can keep an income stream back to you so long as it is determinable. Determinable being uh, X percent, a fixed percent of the trust assets, either determined annually, because this is going to change every year depending on market, or say January 1st, a fixed percent of this annually, or a fixed percent of what it was worth when it went in, no matter what it changes to later. So in our example, say the donor can keep 5% of a million for 20 years, 5% of a million every year for 20 years, or 5% of whatever's in here as of January 1 of each year for 20 years. That's going to change a little bit because this is going to change, and we're going to determine 5% of this every year. Um, but it's still determinable to some extent. Or 5% of a million, because that's what it was on day one when it went in. No matter what this changes to, my donor is going to get 5% of a million for the next 20 years. And 20 is just a variable. I'm going to talk about that in a minute. 20 can be 10, it can be 15, it can be 5, it can be anything. But in my example, it's 20. So if you add that add that certainty to this, then that adds certainty to this, because it's a million minus this equals this, what's going to charity. And we need to know what's going to charity in order to get our charitable deduction in day one when we set this up. If this is designed to last for 20 years, we're setting it up in 2020. And so charity's not getting any money till 2040. But I'm taking a deduction in the year 2020. In order to take that deduction, I got to know in 2020 what I think the charity's going to get in 2040, 20 years from now when actual dollars pass to the charity. And we can do that if we add some certainty on what the distribution amount to the charity is, to the donor is each year. All right. So look at the PDF titled Charitable Remainder Annuity Trust. And I want to walk you through, it's a lot of data on a piece of paper, but I want to walk you through it. The first line says trust type term. That means I am setting up a trust with a fixed term that my guy is going to get the income stream or the annuity payment back to him. The transfer date is March of 2020. 75/20 rate, I'll come back to that in a minute. Fair market value of the trust, I put in $1 million into this trust. I'm assuming the trust is going to have some growth. I'm assuming that $1 million isn't going to stay stagnant, and I'm assuming it's 6% growth on $1 million, which right now is seemingly impossible. But we will get back to a point in time where that is an amount that's doable. Next line down, percentage payout. I have to define how much is coming out of here by a percentage. Remember, percentage of this, either as the setup of the trust or a percentage of this determined annually. In my case, I determine 5% of the $1 million is going to come out on an annual basis for a term of 20 years. Now, skip a few lines down, you'll see a line called amount of annuity. That's $50,000. All that is 5% of $1 million each year. My client's going to get an annuity of $50,000 per year every year. So if you go down, you'll see a chart that's got year 1 through 20. Beginning principal was $1 million. 6% growth on that principal was $60,000. My payment out to my donor was $50,000, which means at the end of year 1, my remainder has an interest of $1,010,000. What I want to do, if you take all that does for 20 years, is take that through a situation where it just plays that out for the next 20 years. The investment growth less the distribution amount to my client ends with a remainder interest of about 1.367. That's what should go to the charity if this played out perfectly. Now, certain things are going to play out perfectly. The payment of $50,000 is going to happen. The 6% growth isn't. It's never going to be a flat 6% growth every year. But that doesn't matter for purposes of the deduction. Go back up to the middle part of the screen of the PDF payment. Fourth line, 1, 2, 3, 4. Fourth line down in the middle section. Present value of annuity. The actuarial value of that annuity of $50,000 per year for 20 years is $802,010. That an actuarial has determined that's what $50,000 coming out for 20 years is gonna be worth. The charitable interest of the remainder is simply math. It's $1 million, what I put in, less the actuarial value of the annuity, $802,010, equals $197,990. It's just subtraction math. That's our charitable deduction in year one when we set this up. It's $1 million less the actuarial value of our taking $50,000 for 20 years equals a number, and that number is $197,990 on this printout. That is what I can list as a charitable deduction in year one when I set this up. Year one either being setting up during my life, or year one being if I set it up in my will in the year that I die. And that is a summary of how a charitable remainder annuity trust calculation works. It's what went in less what the actuarial value of what comes out, which has some fixed components to it. It's either an X percent of what went in on day one or X percent of what's in here on day one of every year, comes out, equals a number. And we go back to our PDF, $1 million in the middle section of our PDF, starting with amount of annuity. $1 million went in, less the present value of my annuity is $802,010. That's the present value of getting $50,000 a year for 20 years, equals a remainder interest of $197,990. And that is what is going to charity actuarial, and that's what we can put on our tax return as a charitable deduction. All right, let's stop there.